Hello, this is Mike with netpicks.com and the Options Mastery Program. In this video, I want to take a few minutes to show you how easy it is to identify trades using options. One of the questions that I get on a very regular basis is, Mike, what do you look for when identifying trades? Okay, there's a lot of books out there, there's a lot of videos that you can watch, there's a lot of programs that you can purchase that start to walk you through what to look for when trading options, but it's a totally different ballgame when you get into live market conditions. It can be a little difficult to pull the trigger with any type of confidence when you don't really fully understand the products that you're using. So let's walk through some of the basic approaches that I use to identify trades without the use of any type of complex indicators. We're really just looking at the price of the stock and the price of the options. So let's start out by taking a look at a couple of pretty popular products. We'll start out with Twitter, symbol TWTR. Okay, really common name, really popular among active traders. So when I look at this chart, yes, I have some moving averages on here. It's a mix of simple moving averages and exponential moving averages. I've got the Williams %R indicator down at the bottom. Okay, I'm not going to use any of those to place the trade. All I'm going to do by looking at this chart is I want to form an opinion on what I expect Twitter to do going forward. Okay, I need to decide, do I want to be bullish, bearish, or neutral? Okay, the nice part about using options to trade, you can use them to benefit from all types of market movement. When you sit there and buy shares of stock, or buy a futures contract, or you're involved in the Forex markets, you really have to choose whether the market's going to go up or down, because all you can do is buy or sell that product. Okay, when we start trading options, there's things that we can do that just really expand our potential profitability. We're not locked in to picking a bullish or a bearish stance on the product, but we do want to form an opinion on what we expect to happen going forward. So this is just a basic daily chart. Okay, so it's just plotting price action for each trading session, and I'm going back on this chart 6 months. You could go back a year if you wanted to. I'm just looking at a quick snapshot of Twitter. So when I look at Twitter, it's gotten beat up. Okay, the overall market has seen a nasty pullback here over the past couple of weeks, and as a result, there's many products out there that are at an extreme on the downside. Okay, now when I say extreme on the downside, I'm not talking about being at an extreme for the next 6 months. I'm talking in the very near term, I could potentially see a bounce. Okay, so if I look at this chart on Twitter, you can see over the past couple of weeks, we're at an extreme on the downside. We've put in a low down at the 21 level. We have bounced off of that low, and now we're kind of settling into a range. So based on this price chart alone, no other indicators, I'm looking at this and saying, okay, I would anticipate Twitter either continuing the bounce higher or settling into a range and moving slightly sideways. Okay, now if you look at that chart and if you've got a neutral outlook, if you think that Twitter is going to get choppy and just move sideways, oftentimes people just throw that stock away and move on to a product that may look a little bit better for a breakout. Okay, that's not necessarily the case here because we're going to use options. So let's go over to a trade page here. This is using Thinkorswim. You can use any options broker out there and find all of the same information. So when I pull up Twitter on the trade page, let's go ahead and shrink this down here a little bit. We've got all of these different expiration cycles over on the left-hand side. Okay, so options contracts are only good for a certain amount of time. It's very similar to an insurance policy, right? So that insurance policy, whether it be on your car or your home, it goes month to month, right? So it's a very similar idea here with options, but you'll also notice that we have weekly options in here as well. We have options that will expire once a week, and then we also have options that expire once a month. Okay, for these types of strategies, I really like to focus in on the monthly options. I don't like to mess around with the weeklies. There's additional risk. It takes more attention to detail when placing trades with weekly options. This is the type of trade that I'm going to walk you through. I'm really looking to get in and out, okay, without having to track this trade every minute of the day. I really want to get in couple times a day, just for a couple minutes at a time, check in on the trade, make sure everything's doing what I expect it to do, and then move on with my day. So we're going to go out to the October options with 30 days left. Okay, so based on that chart, we decided that we were going to place either a neutral to slightly bullish trade. Okay, for me personally, I just decided to put on more of a bullish trade with the potential of surviving with a neutral outlook. So let's talk through what we want to do. Most of the time when you're bullish, okay, you're either going to buy the stock, or if you're trading options, you could buy a call option. When you buy a call option, the problem there is any time that you pay to put a position on, okay, that time decay is going to work against you. Every day that you hold that position and the stock does not move in your favor, you're going to lose money. So when you buy a call option, while you do have incredible profit potential, you've also got some risk there. Okay, you need that move to happen quick enough in order to make money. Otherwise, you're going to be stuck there looking at a position that's going to lose value. Okay, so will I buy long calls if I'm bullish? Yes, but I have to have a very strong bullish outlook. So what are some other things that we could do? Well, we could buy a call spread. Okay, buying a call spread, it's placed by buying a call option and then selling a call option that's further out of the money to create a hedged position. You can lower your costs and lower your risk. Okay, but there again, with the long call spread, I only make money if Twitter moves to the upside. Okay, I'm paying to put that position on. So what we're going to do with this trade that I'm going to look at today, let's take a slightly different approach. Okay, instead of buying a call or buying a call spread, let's actually look at selling a put spread. Okay, by selling a put spread, it still is a bullish strategy. We still want Twitter to move to the upside, but we have a few additional ways of booking a profit. Okay, instead of having that time decay working against us like we just talked about on the long call or long call spread, let's try to put some time decay in our favor. Okay, so what I want to do here, we take a look at the current price of Twitter. It's at $27.25. Okay, give or take a few pennies. Okay, so what I want to do is go out into October with 30 days left, and I'm going to look at selling the 27.26 put spread. Okay, so I'm going to right click on the 27 put. I'm going to go down to sell. I'm going to go to vertical, and it's going to load up by default the 27.26 put spread, and it's trading for 42 cents. So what this trade is going to do, I'm going to sell the 27 put, and I'm going to buy the 26 put to make it a hedged position. And I'm going to collect, well, it's currently trading for 41 cents. It's flipping back and forth between 41 and 42 cents. Okay, so when I open this position, I'm actually getting paid 41 or 42 cents depending on where it's trading. We'll call it 41 cents because that's where it's at right now. Okay, so what this does, we are collecting premium to put this trade on. Okay, now all of a sudden we're putting time decay in our favor. Our hope on this trade is that this trade is going to get cheaper. It's going to lose value, so when we go to close it out, we're hoping to buy it back cheaper. Okay, we'll walk through that here more in just a second. So when we collect 41 cents here, that's $41 per spread. That $41 is the most that we can make on the trade. What am I risking to put this trade on to collect that 41 cents? I'm risking 59 cents or $59 per spread. And that's calculated by taking the difference between the strikes. There's a $1 difference here between 27 and 26. And we're going to subtract the 41 cents that we're collecting. That's going to give us a $59 risk. So for some of you experienced traders, you might look at that and say, okay, that's not even a 1-to-1 reward to risk ratio, Mike. It's really not a great trade. Here's the neat part about this. We mentioned that this is a bullish trade. We want Twitter to move to the upside. If Twitter moves higher, this put spread is going to lose value, and we're going to be able to buy it back cheaper. Okay, so we make money if Twitter moves higher. We also make money if Twitter moves sideways. Okay, because we're selling premium, okay, we're giving ourselves more ways of being profitable. Look at our break-even point. It's $26.59. Okay, that is calculated by taking your short strike, the 27 strike that we sold, the 27 put, and we're going to subtract the 41 cents that we collected. Okay, that's going to give us our break-even point of $26.59. As long as Twitter stays above $26.59 by October expiration, we can make money. So over the next 30 days, if Twitter moves higher, we make money. If Twitter moves sideways, we can make money as long as it is above $26.59. If Twitter moves lower, if we're completely wrong on direction, we've got a little bit of wiggle room below us. As long as Twitter's above 26.59, we make money. So we could potentially make money in all three types of market moves. Okay, we also make money with time decay because we're selling a spread here. Think about this as if we were the insurance company selling the policy to a customer. Okay, we're selling an auto insurance policy. Okay, so when that customer buys the policy, as each month goes on that they don't make a claim, if they don't get in an accident, for example, okay, the insurance company gets to keep that premium, right? Okay, so when we sell this put spread, we're essentially the insurance company, we're issuing the policy. Okay, as long as Twitter stays above 26.59, okay, the person that's buying that spread from me, okay, as long as they don't make a claim, we get to keep that premium. So what we want to have happen here, okay, we want Twitter to either stay sideways or move higher, but we also have a little bit of wiggle room on the downside. And each day that we hold this trade, we get to keep a little bit more of that premium. Just like that insurance policy losing value each day that it's held without making a claim. Okay, so we're going to make money every day on this trade with time decay. We also make money if volatility decreases. Okay, I didn't even talk through this one. Okay, if I come down and take a look at the option statistics down here, okay, if I take a look at these volatility levels, okay, they're actually high. We look at Twitter all the time. Based on the past 52 weeks, the volatility of these options are high, and that's no surprise given that the market's been a little beat up here the last few weeks. So if volatility decreases and goes back down to a more normal level, we can also make money. Okay, so instead of buying a call or buying a call spread where we only make money if the stock moves higher, and we only make money if the move happens fast enough, now by selling the put spread, we're still putting on a bullish strategy. We make money in all three potential market moves like we just talked about. We make money if time decay adds up, and we make money if volatility decreases. So now instead of having to see everything fall into place by buying premium, by buying that call or call spread, we can make money in 5 potential scenarios by selling this put spread. Okay, so even though by collecting 41 or 42 cents, even though we don't have a 1-to-1 reward to risk ratio, we're actually risking a little bit more to make a smaller profit. We have many more ways to make that profit. Okay, now you don't hear a lot of people talking about these strategies because when you put on a short put spread like this, you're essentially giving up the potential for a home run trade. The most I can make on this trade is 41 bucks. Okay, so it's not the exciting 200% winner that you'll hear from people buying call options and put options. But you're really going to increase your odds of success by trading like this. We're just giving ourselves a multiple different ways of making a profit on the trade. Now, when I say only $41 per spread, my buying power here, okay, it's right around 62 bucks. That's with commissions, $62 per spread. Okay, so even though you're only making 41 bucks, you're only risking 62 bucks. So for many of you, you can put this trade on 3, 4, 5, 15, 20 times depending on your account size. Okay, so it's a really inexpensive trade to put on, and you're really going to start to increase your overall odds of success. Okay, so let's just take that 26.59 number. Let's go back over to the chart here. And let's just go ahead and put on a line here. Let's try to get it at 26.59. It's not to the penny, but it's pretty darn close. So you can see here from the chart, we've got a tiny bit of wiggle room to the downside, but we really want Twitter to either move sideways or higher. As long as it does so, we don't need a huge move to the upside at all. If that happens, great. All we need to do is either stay inside of this range or move higher. Okay, so really, really great type of trade. It's often overlooked because a lot of times people, you kind of have to reverse your thinking. Instead of buying premium, we're selling premium. And that the best example that I know of, because everybody's familiar with it, is using that insurance example. Okay, let's take a look at one more. Let's switch our products here. Let me go back over to the chart, and we're going to switch the product to XRT. Okay, XRT is an ETF tracking the retail sector. Okay, so with the Fed potentially raising interest rates, with all these central banks trying to prop up the economies worldwide, a lot of focus is on the retail, the consumer, and how much is going to be spent here heading into the end of the year, through the holiday session or the holiday season. So when I look at XRT, this could be a chart that I potentially want to put a play on. Okay, so much like we did on Twitter, I'm going to focus here on XRT, and I'm going to look at the chart, look at the daily chart over the past 6 months, and I need to make an opinion. I need to make a judgment call here. Do I want to be bullish, bearish, or do I want to be neutral? Okay, when I look at this chart, we've seen a big move lower, and price action has recovered. So when I look at this chart, I actually think over the next month, we could potentially settle into a little bit of a range here. Why is that? Well, there's a lot of people that are going to be anticipating what the holiday sales are going to look like. Okay, we won't know that obviously till the end of the year. So with all that anticipation, we could see some choppiness kick in. No one wants to place a big bet in one direction or the other without knowing what the consumer is going to do. So I want to potentially put on a neutral trade. So let's walk through what that could potentially look like. So let me go over to the trade page, and let's take a look at XRT. Now I'm going to stay with the monthly options in October, just like we did with Twitter. Now instead of selling the put spread, which on Twitter was more of a bullish strategy, I want to put on more of a neutral strategy here. So what I want to do is use options to essentially create what's called a profit window. And we're going to do that by using an iron condor. Now the iron condor, I know it's a funky name, and it sounds complex. It's really not. It's a very, very simple strategy when you start to break the components down into detail. So when I say I want to create a profit window, essentially what I want to do is box the price in. I don't care if it goes up, down, or sideways. As long as it stays in a tight range, I can make money. So we're going to go out into the October options. XRT is currently trading for 46.50. Okay, so what I want to do as best as I can is I want to create a window around that 46.50 price, and I want to try to box it in. So the iron condor, the definition is simultaneously selling an out of the money call spread and a put spread in the same expiration cycle. So we're going to go into October options, and we're going to try to sell an out of the money call spread and a put spread at the same time. So what I'm going to do, let's take a look at some of these different strikes in here, and let's go ahead and let's take a look at selling the 47.5 call. I'm going to right click on it, go down to sell, and I'm going to go to iron condor. Now by default, it's going to load up an iron condor down here, and we're going to be able to adjust these strike prices around a little bit to create something that we feel comfortable with. Okay, there's 50-cent wide strikes here. If I looked at the strike prices down the middle, you're going to see that there's a difference of 50 cents between each strike. I'm going to try to put on an iron condor. In this example, I'm going to try to stretch these out to dollar-wide differences between the strikes. And what I want to do here is I want to find an iron condor where I can collect around 50 cents. That's kind of the goal here with these strikes. So what I'm going to do is, instead of using the 47.5 48 call spread, I'm going to stretch the 48 call out to 48.5. So we're going to sell the 47.5 48.5 call spread. So just like we did on Twitter, we're going to sell an out of the money spread. So I'm selling the 47.5 call, and I'm buying the 48.5 call to make it a fully hedged position. Okay, so that's the first side of the trade. Now on the put side, what I want to do is I want to adjust these strikes, and I'm going to go down to 45.5, 44.5. Okay, so in this case, I'm selling the 45.5 put, and I'm buying the 44.5 put to make it hedged. So even though there's 4 different options as part of this trade, it's important to point out that this is a fully hedged position. Okay, it's a risk-defined position. You're going to know exactly what your potential profit and loss will be before you ever get into the trade. So notice my short strikes, the 47.5 call and the 45.5 put, what I'm trying to do there is I'm trying to box in the current price of XRT. So now what I've done, we're going to collect 53 cents to put this trade on. So let's go ahead and hit confirm and send. So if I collect 53 cents, that 53 cents is the most that I can make on the trade. $53 per spread. What's my risk? Well, it's again taking the difference between the strikes, which is $1. We just talked about that. And we're going to subtract the 53 cents that we collected. That's going to give us a maximum loss of 47 bucks. Okay, so it's just better than 1-to-1 on the reward to risk ratio. Here's why this trade is so neat. Look at the break-even prices, $44.97 and $48.03. Those are calculated by taking our short call strike. We're going to tack on the 53 cents that we're collecting. We're going to take the 45.5 put that we sold, and we're going to subtract 53 cents. Okay, and that's going to give us our break-even points. So on this one, that's our profit window. We don't care if XRT goes higher as long as it closes below 48.03. I don't care if it goes lower as long as it closes above 44.97, or if it goes sideways. As long as it's inside of that profit window, we get to make money. So now what we're doing with this trade, we're taking direction out of the equation somewhat. We don't have to determine, do we want to be bullish or bearish? We're giving ourselves a way of scratching out a profit if this stock does absolutely nothing. Okay, so let's go ahead and let's take those break-even points, and maybe it'll help with a visual. So let's go over to the chart here. And let's go ahead and draw some price levels at those break-even points. So we mentioned the break-even point on the upside is right around the 48 level, just above 48. And the break-even point on the downside is just below 45. Okay, and actually let me get some of these moving averages off of there so you can clearly see it. Okay, so this is our profit window, those red lines that I just put on the chart. We can make money as long as XRT stays inside of that range. If it goes higher, we can make money as long as it stays below the red line. If it goes lower, as long as we stay above the red line, we make money. Okay, these are the neat types of trades because now we put the odds of success in our favor in 3 different types of market moves. We profit from time decay like we talked about on Twitter, and we profit if volatility decreases. Okay, if I go back over to the trade page, you're going to notice that the volatility levels are elevated. Based on the past 52 weeks, the volatility is actually high. Okay, so I'm expecting volatility to go lower. So we make money in multiple different scenarios there. Okay, oftentimes people are so programmed to just pick whether you want the market to go up or down and then buy a call or a put accordingly. You can actually take this a step further. If you're not as strongly bullish or bearish, there's things that you can do to scratch out a profit. Okay, in our options mastery program here over the past 5 to 6 weeks, we've been talking about some of the short premium trades. And we put on 5 new short premium trades just before the market tanked. The last couple weeks we saw a significant pullback in the market. Okay, out of those 5 trades that we put on, we won in 4 of them, and we took a small loss on the 5th. Okay, so even though we were expecting the market to be somewhat quiet, we weren't expecting a historic move to the downside. We were completely wrong on market direction, and we still won in 4 out of 5 trades. Okay, that's the neat part about selling premium. So hopefully you found this video beneficial. I'll continue to post some trades here going forward to walk you through some different ways of approaching the market. I know it's a different approach than what many people are taught, but you can really start to increase your odds of success when you start to expand your options playbook. All right, so I'll be back here in the coming days with the next video. Happy trading, everybody.